Hello and welcome everybody. I'm Vern Cushenberry back with another market update after a pretty wild 2020. I want to take a few minutes and level set on expectations for 2021, share a little bit of market data with you, and segue into a timely piece on the state of retirement in our industry and how it's affecting some of the asset allocations that we use for retirement or for our clients as we think off on the horizon a little bit. But first things first, as we sort through the data on a quarterly basis, we always take a look at what the markets have done. And you can see here, after a 34% decline in the first quarter of 2020 on account of COVID, we saw a 68% rebound, which was beyond almost everybody's expectations. And that was a direct result of the nearly $4 trillion worth of stimulus that our lawmakers injected into the economy. And you can see the stock market benefited from that. One of the data points on this slide I just wanted to point out is the 10-year Treasury yield. When the government stimulates the economy, they usually do it by buying treasuries, and increased demand for treasuries leads to lower yields. Those two things are inversely related. And as of the end of the year, this is the lowest yield on a 10-year Treasury that we had ever seen. And we saw an intra-year low close to 0.5%. So it's a real war on sabers out there. It's very challenging to earn a return in the market without taking on risk, and that has implications for your retirement portfolio. So as with every quarter, we recall that price is what you pay and value is what you get. And here's a slide that takes a look at value over the last 25 years. And we measure that simplistically by looking at price relative to earnings. And you can see here that this ratio typically ranges between 13 on the low end, which would be cheap, and 19 on the 20 on the high end, which would be expensive. And here's the bear case for the markets right now. The markets look expensive. If we don't see a significant rebound in earnings, which is likely, but if we don't see it, then that's our bear case. And we've been having conversations with our clients about their comfort level in this market and what their portfolios can withstand. And we stress test those portfolios, and we just want to make sure that the financial plans that we have built for our clients can weather all storms, so to speak. Okay, let me move down to slide number 6, and I wanted to talk briefly about the expectations that are built into those market valuations that I just showed you a moment ago. One of the reasons why valuations are so high is because, by and large, analysts expect earnings to rebound significantly in 2021. And you can see here that the blue is future earnings. So you can see that Wall Street as a community expects corporate earnings to rebound moving into the second and third quarters of 2021 to levels that would represent a record level of earnings. So if that happens, we've just outlined the bull case for markets going into 2021. And if you throw some potential new government stimulus on top of that to maybe drive those earnings a little bit, we could continue to see good market returns through the next few quarters. Now, I have trained myself to think in terms of bull case and bear case on any given day. I look like a schizophrenic to the rest of the people in the office here, mumbling to myself about the merits of both the upside and the downsides of the markets. And that's what a good practitioner has to do. You have to understand the risks to whatever investment thesis that you're working with. I want to go down tons of data here. Happy to share all this, but in our quarterly videos, I just highlight a few slides. And I try to highlight what's on investors' minds. And certainly one of the data points on investors' minds this quarter and all year is COVID-19. And you can see that we do see that second wave. We heard a lot about that earlier last year. And the second wave is definitely manifested in the data. You can see confirmed cases and fatalities both spiking moving into December. Hopefully that has rolled over as we get that vaccine in place. We've seen a lot of enthusiasm for that in the markets. That's been another tailwind pushing the markets forward. So we're very, very hopeful, and certainly the market has priced some of that in going into 2021. Okay, the next hot topic, so to speak, would be the election. And we get a lot of questions about the election right now. And I want to share this slide. Shared this with our clients last quarter, but it's a good one. So we took a look at the last 60 years of elections and historical returns in different administrations, and we were looking for patterns. Does the market do better in a Republican administration? Does the market do better in a Democratic administration? Long story short, we couldn't find any patterns at all. And President-elect Biden is getting ready to take office next week. With the two Senate elections in Georgia having gone Democratic now, it looks like we're going to have a 50-50 tie in the Senate. There was a lot of prognostication leading up to that election that a 50-50 tie in the Senate, which will be decided by Vice President Kamala Harris, gives the Democrats a slight edge in the Senate and will allow a lot of new policies to be pushed through. I think that might be a little overblown. If you look at the breakdown in the Senate, it's not actually 50-50. It's actually 50-48-2. There are two independents in the Senate right now. They just are categorized as Democrat because they caucus with the Democrats. But I think that's going to create enough of a power imbalance, or I guess power balance, if you will, to moderate a lot of the legislation that gets pushed through. And certainly that's what the way the markets have reacted. Because when we have a moderating force in Washington, the markets feel like they can better anticipate what's on the horizon. So, and that's always a good thing for stocks. Certainty is always a good thing for stocks. So I just wanted to touch on that briefly. And then I wanted to share slide number, let's see, 33 here. This is a big driver of the markets. This is on a lot of investors' minds, and it's inflation. How do the markets perform in an inflationary environment? And let me back up one slide here real quick and actually look at what inflation has been. Here's the numbers. They have been very low. As of November, the headline CPI was at 1.2%, and you can compare that to a 50-year average of 3.8%. So virtually non-existent. We haven't had to deal with much inflation in our economy at all, which is one of the reasons why the Federal Reserve and the government has been able to be so aggressive with the stimulus efforts. But we, as financial professionals, need to be prepared for what happens when that environment changes, because it will change. It's just a question of when. So I have this chart here that I was going to share today that takes a look at rising inflationary environments and falling inflationary environments, and inflation that's currently high or currently low. So we're currently low, so that puts us in the bottom half of this chart. And we have been experiencing falling inflation now for the last 8 years-ish. And you can see how the markets have performed. Growth stocks typically perform well in a rising inflationary environment. Commodities typically do very poorly, and that's exactly what we've seen. If that scenario were to reverse itself, we might expect for emerging markets, commodities, and real estate to do a little bit better. And when we look at our retirement portfolios, we like to make sure we have a healthy amount of inflation protected assets. And for retirees in particular, we like it for those to be as safe as they possibly can. So we use, we use Treasury inflation protected securities. And I can show you how those comprise part of our asset allocation too. Okay, so that's a quick market overview. I had a couple of historical pieces I was going to share with you. One that came across my desk from the Visual Capitalist here in the last few months was a little infographic, which I love, and I want to put a plug in for the Visual Capitalist. I think that they are one of the best sites on the internet for digesting massive amounts of information, because if you can't present massive amounts of information visually in a way that people can really understand, you're just not getting the most out of it. So we know we have an emerging retirement plan crisis, and this chart puts that in perspective, really on account of well, it was right here, higher life expectancies. And then people are spending longer amounts of time not working, which is a great thing. It just requires bigger balances to fund that. So if we don't have those balances, you can plan on working longer, or you're going to have to save more to get there. So this infographic quantifies the value of that retirement gap. And you can see that if you look across the major developed trading partners, here's the United States. We currently have a gap of about 28 trillion, and that's going to rise by about 5% between now and 2050, creating a gap of about $130 trillion. So how do we manage through that? And I'm happy to share this infographic with anybody that might want to learn a little bit more, because it's a little hard to see on this screen, I know. But how do we manage through that? One of the ways that we manage through that is with something called the stride indices, or the cost of retirement index that's put out by our partners at S&P Dow Jones. They help us keep tabs on how expensive it is to retire. And I just shared with you how interest rates have been declining now pretty significantly for the past 7-8 years. Well, as interest rates decline, those investment portfolios that are earning interest, they don't earn as much interest anymore. So you have to have a bigger balance to generate the same amount of funds. So if you have retired on a $50,000 a year annual lifestyle and interest rates are at 10%, well, you need a $500,000 portfolio to generate that lifestyle. But now if interest rates fall to 1%, you need a $5 million portfolio to generate that lifestyle. And you can see that the cost of that income just increased dramatically. And that's exactly what happened last year. And Standard & Poor's helps us quantify that. And I can show you here, they publish this quarterly. And you can see here in this chart, they call this the cost of retirement income. So how much does it cost to secure $1 worth of income in retirement that's also protected from inflation? And you can see the gray bar was December 19, and then the blue bar was September 20, and then the, I guess, dark blue would be December 2020. And if you wanted to secure that income stream beginning 2035, well, it cost you $21 last December 19, and it cost you $28 a year later. Well, that's an increase of not quite a third. Just call it a 20% increase or so. That's a dramatic increase in the cost of retirement. And you're trying to see, you're beginning to see why we have a retirement crisis on our hands. So what do we do with that information? Well, for our retirement clients, for those saving for retirement, we try to lock that in as soon as we can. And we do that with an exposure to Treasury inflation protected securities, so that when inflation is on the rise, we're protected. When the cost of retirement income goes up, the assets that we have inside of our portfolio simultaneously go up. That's what a Treasury inflation protected security is. Now, as we layer those into our asset allocation across our retirement portfolios, we can begin to add a level of security to just that goal, that retirement goal that we're really after and trying to protect against. So let me clear that, and I can share with you the asset allocation inside some of our goal path portfolios. We use these inside of our retirement accounts with our institutional clients. And then for our wealth management clients, we can recreate some of these asset allocations and be even more tailored with the allocation to fit an individual's needs. And you can see here on this asset allocation slide, we have a healthy allocation to fixed income, and a good portion of that fixed income is in the inflation protected securities portfolio. So that's one of the ways, along with an exposure to some real estate and maybe some commodities, and we're having these conversations in real time with all of our clients. And the end of the day message back to everybody that we do business with is make sure that this asset allocation is powering a financial plan that has been stress tested to meet not just your retirement goal, but all of your goals. And we can keep track of those. A well-built financial plan will keep track of all of those goals. And the reporting comes back to you periodically, and it's an iterative process, and that's the real value of working with a financial planner. So I feel like I was a little bit long-winded this quarter, but lots of great stuff. And I just want to thank you for your time, and rest assured, we'll be back next quarter. Thanks.